Hey everyone, welcome to Macro Signal, where we deliver clear, actionable intelligence on protecting your hard-earned retirement income. And right now, in these critical first 30 seconds, listen carefully, because here is the powerful 2026 SSA Tax Alert value point that can save you thousands of dollars this tax season, thanks to the enhanced senior deduction of up to $6,000 per qualifying person aged 65 and older, introduced under the recent tax legislation. Combined with smart planning strategies, the vast majority of Social Security benefits recipients can effectively keep their Social Security benefits completely untaxed or minimally taxed at the federal level for tax year 2026 if they take action before the April 15th deadline, potentially adding between $1,100 to $3,500, or even more directly back into their pockets without reducing their lifestyle one bit. If you are currently receiving Social Security benefits or planning to claim them soon, then I strongly urge you to watch this entire video from beginning to end without skipping any section, because every single strategy example and detailed explanation I am about to share has been proven to help thousands of beneficiaries successfully keep their Social Security benefits untaxed, and missing even one key point could mean leaving hundreds or thousands of dollars on the table in unnecessary taxes to the Internal Revenue Service. So commit right now to watching this complete video all the way through as we break down everything you need to know about the 2026 SSA Tax Alert on keeping Social Security benefits untaxed. Today on Macro Signal, we are providing an in-depth professional exploration of the 2026 SSA Tax Alert, focused entirely on keeping Social Security benefits untaxed, exploring precisely how Social Security benefits taxation rules operate in practice, what the combined income calculation truly means for real retirees, and most importantly, the comprehensive set of proven strategies that allow beneficiaries to minimize or completely eliminate federal taxes on their Social Security benefits so that the money you worked decades to earn stays where it rightfully belongs, in your own pocket for your own retirement security. And by the time you finish watching this full detailed presentation, you will possess a complete professional toolkit ready for immediate implementation. We begin with the foundational understanding that Social Security benefits, which encompass retirement benefits, survivor benefits, and disability benefits paid under the Social Security Benefits Program, remain potentially subject to federal income tax based on your total financial situation. Yet the outstanding news in this 2026 SSA Tax Alert is that through deliberate planning and utilizing available provisions, the large majority of recipients can successfully keep their Social Security benefits untaxed year after year. The central legal concept that governs this is called combined income. And I repeat, combined income is defined as your adjusted gross income, excluding any Social Security benefits, plus any tax-exempt interest income, plus 1/2 of your total Social Security benefits. And once again, combined income serves as the exact formula the Internal Revenue Service applies to determine what, if any, portion of your Social Security benefits becomes taxable. For tax year 2026, if your combined income remains below $25,000 for single filers or below $32,000 for married couples filing jointly, then none of your Social Security benefits face any federal tax, meaning you retain 100% of those Social Security benefits completely untaxed. However, if your combined income moves into the middle brackets, then up to 50% of your Social Security benefits can become taxable, and once above the upper thresholds, up to 85% of your Social Security benefits may be subject to taxation. And these combined income thresholds have stayed unchanged since the 1980s without inflation adjustments, which explains why increasing numbers of retirees unexpectedly face taxation on their Social Security benefits, making this 2026 SSA Tax Alert essential viewing for anyone serious about retirement income protection. Consider the real-life case of Robert, a 72-year-old retiree living in Florida, who contacted our team after receiving an unexpected federal tax bill exceeding $2,000 directly tied to his Social Security benefits. Robert's combined income had reached $38,000 due to a combination of pension payments and tax-exempt interest from municipal bonds that still counted toward the combined income formula, thereby pushing 35% of his Social Security benefits into taxable territory. After carefully applying the detailed strategies we outline throughout this complete video, including optimized withdrawal sequencing and fully claiming the new enhanced senior deduction, Robert not only eliminated all taxation on his Social Security benefits for the current year, but also successfully amended prior returns to recover overpaid taxes, ultimately saving him several $1,000s overall and restoring his financial confidence. Let us examine the combined income calculation with even greater precision, because mastery of this formula is the foundation of keeping Social Security benefits untaxed. And I repeat once more that combined income equals your adjusted gross income, calculated without including Social Security benefits, plus all tax-exempt interest, plus exactly 1/2 of your Social Security benefits. And this combined income number is what the Internal Revenue Service relies upon exclusively when applying the taxation tiers to your Social Security benefits. Thorough understanding of this combined income formula empowers you to manage every contributing element proactively, so your Social Security benefits stay untaxed. And one common pitfall many beneficiaries encounter involves tax-exempt interest from municipal bonds, which, although exempt from regular federal income tax, nevertheless gets added into the combined income calculation, often catching retirees by surprise and unintentionally triggering taxation on their Social Security benefits. The 2026 tax year brings particularly encouraging developments through the enhanced senior deduction of $6,000 per qualifying individual aged 65 or older available under the new provisions, which can meaningfully help many people remain below the combined income thresholds where Social Security benefits taxation begins. This enhanced senior deduction functions as a true game changer for keeping Social Security benefits untaxed, especially when layered together with the other advanced strategies covered in depth throughout this video. If you qualify as 65 or older and your modified adjusted gross income falls within the eligible limits, claiming this enhanced senior deduction represents one of the most impactful single moves available this tax season for protecting your Social Security benefits. A highly effective strategy for keeping Social Security benefits untaxed centers on thoughtfully delaying your claim for Social Security benefits whenever feasible until you reach full retirement age or even age 70. Delaying not only permanently increases your monthly Social Security benefits by as much as 8% for each year you wait, but simultaneously provides additional years to optimize other income sources without pushing your combined income into ranges that would tax your Social Security benefits. Take the detailed example of Margaret, a 67-year-old widow whose combined income sat dangerously close to the 50% taxation bracket on her Social Security benefits. By strategically delaying her survivor benefits for 2 additional years, while carefully drawing from other savings in a tax-efficient manner, Margaret successfully maintained a lower combined income, so that when she finally began receiving her significantly higher Social Security benefits, they arrived almost entirely untaxed, delivering tens of thousands of extra dollars in lifetime retirement security. Delaying Social Security benefits when possible forms a cornerstone strategy worth evaluating seriously within your personalized plan. Another cornerstone approach for keeping Social Security benefits untaxed requires meticulous management of withdrawals from traditional individual retirement accounts and 401k plans, because such distributions add fully to your adjusted gross income, thereby inflating your combined income and potentially subjecting up to 85% of your Social Security benefits to taxation. A powerful alternative involves executing Roth conversions during lower income years before you begin collecting Social Security benefits. Through these Roth conversions, you pay taxes on the converted amounts at today's potentially lower rates, while ensuring that all future qualified withdrawals from the Roth accounts do not contribute to your combined income at all, thereby helping keep your Social Security benefits untaxed for the remainder of your retirement. Numerous clients have implemented phased Roth conversions over multiple years and dramatically reduced their lifetime tax exposure on both retirement distributions and Social Security benefits. For instance, John and Linda, a married couple both in their late 60s, maintained large traditional individual retirement account balances that triggered substantial required minimum distributions, spiking their combined income and causing 85% of their Social Security benefits to become taxable. Working closely with a qualified tax professional, they executed partial Roth conversions during years when their overall income remained manageable, paid the conversion taxes using non-retirement funds, and by the time they activated their Social Security benefits, their required withdrawals had been minimized significantly. The outcome was a sharp drop in their combined income, allowing nearly all of their Social Security benefits to remain untaxed and delivering annual tax savings exceeding $4,000. This level of strategic, detailed planning is precisely why staying engaged with a complete video until the very end proves so valuable. Investment income management stands as yet another vital area when working to keep Social Security benefits untaxed, since interest dividends and realized capital gains from taxable brokerage accounts all increase your adjusted gross income and therefore your combined income. One intelligent tactic involves reallocating income-producing assets into more tax-advantaged structures where feasible or concentrating on highly tax-efficient investments such as broad market index funds characterized by minimal turnover that generate fewer taxable events. Municipal bonds require special attention because although their interest remains tax-exempt for standard federal tax calculations, that same interest still contributes to combined income, potentially triggering unnecessary taxation on your Social Security benefits. Many successful beneficiaries have restructured their investment portfolios thoughtfully to lower combined income while continuing to generate reliable cash flow and protect their Social Security benefits. Charitable giving, when structured correctly, offers another outstanding pathway toward keeping Social Security benefits untaxed, particularly for those who already support causes they care about. Individuals aged 70 and a half or older can utilize qualified charitable distributions sent directly from their individual retirement accounts to satisfy required minimum distributions without increasing adjusted gross income or combined income at all, thus preserving lower thresholds that keep more of their Social Security benefits untaxed. Sarah, a retired educator with a deep commitment to philanthropy, employed qualified charitable distributions to support her favorite organizations while simultaneously reducing her taxable income enough to drop her combined income safely below the taxation trigger point. Sarah achieved meaningful tax savings on her Social Security benefits while advancing causes close to her heart, creating a perfect win-win outcome that becomes available once you absorb all the strategies presented in this full video. Health savings accounts provide triple tax advantages that indirectly support keeping Social Security benefits untaxed through deductible contributions, tax-free growth, and tax-free qualified medical withdrawals that do not count toward combined income when used appropriately. Maximizing health savings account contributions during working years and deploying those funds strategically in retirement for healthcare expenses can substantially decrease reliance on taxable account withdrawals, thereby helping maintain safer combined income levels. State taxation considerations also matter, although only 9 states currently tax Social Security benefits in 2026. And most of those provide exemptions or deductions aligned with or more generous than federal guidelines. Tax loss harvesting within taxable investment accounts represents another legitimate technique that can offset capital gains and reduce adjusted gross income by up to $3,000 against ordinary income annually, directly lowering combined income and assisting in keeping Social Security benefits untaxed. Always remember to consult a qualified tax professional or certified financial planner before applying any of these strategies because individual circumstances differ significantly and proper application of combined income rules and Social Security benefits taxation guidelines demands personalized analysis. Returning again to the combined income calculation for reinforced clarity, I repeat that combined income consists of your adjusted gross income without Social Security benefits, plus tax-exempt interest, plus 1/2 of your Social Security benefits, and this combined income directly controls the taxable portion of your Social Security benefits. By mastering control over each component within this combined income formula, you retain genuine authority over whether your Social Security benefits remain untaxed. Another compelling success story features Carlos, a 74-year-old veteran receiving disability benefits as part of his broader Social Security benefits package, whose military pension initially elevated his combined income until he restructured certain investments, maximized all available deductions, including the full enhanced senior deduction, and optimized his overall income timing. Carlos now enjoys virtually complete tax-free Social Security benefits, along with greater peace of mind knowing his retirement income has been professionally optimized. The timing of various income sources emerges as absolutely critical when striving to keep Social Security benefits untaxed. If you maintain flexibility with bonuses, consulting fees, rental income, or other variable revenue streams, then strategically bunching or spreading those items across different tax years can hold your combined income within safer zones. Even relatively modest adjustments of a few $1,000s in reported income sometimes determine the difference between zero taxation on Social Security benefits and 50% or higher taxation brackets. The professional methodology consistently promoted on Macro Signal prioritizes proactive multi-year planning instead of reactive corrections after receiving an unwelcome tax notice. By choosing to watch this entire detailed video, you have already taken an important proactive step forward, and I encourage you to take thorough notes, pause as needed, and commit to implementing at least 3 distinct strategies well before tax deadlines arrive. Roth conversion strategies merit even deeper examination because they rank among the most potent long-term tools for permanent protection of your Social Security benefits. During the conversion process, you pay income tax on the converted amount in the year of conversion, but that single controlled tax event can prevent many future years of elevated taxation on both retirement account distributions and Social Security benefits. Sophisticated financial modeling repeatedly demonstrates that performing Roth conversions during the gap years between retirement and Social Security benefits commencement typically produces the largest lifetime tax savings. Managing required minimum distributions after reaching the mandatory age also carries huge importance, and techniques, such as qualified charitable distributions or completing additional Roth conversions prior to required minimum distribution, commencement can keep combined income lower for longer. If you continue working part-time during retirement, remain especially attentive to how that earned income influences your combined income and possibly your Social Security benefits taxation, as well as any earnings test that might apply before full retirement age. Real estate income, rental properties, and self-employment earnings all factor into the combined income equation. So conducting a comprehensive review of those income streams with a knowledgeable tax advisor frequently uncovers additional deductions, restructurings, or timing opportunities that lower combined income without diminishing net cash flow. Throughout your retirement years, maintaining regular monitoring of projected combined income through tax projection software or annual professional reviews keeps you ahead of any emerging risks to your Social Security benefits remaining untaxed. As we approach the conclusion of this comprehensive 2026 SSA Tax Alert, remember that true success comes not merely from understanding the rules, but from confidently applying them in your own situation so you retain every possible dollar of your Social Security benefits untaxed. The combined income thresholds remain fixed for now, but your ability to navigate intelligently around them through disciplined planning separates those who pay avoidable taxes from those who successfully protect their full benefits. If you have found this information valuable up to this point, make certain you continue watching until the final moments, because the concluding strategies and examples may prove the most directly applicable to your personal circumstances, and I want you to leave with the complete professional picture before taking any action. One additional powerful real-world illustration involves a community workshop group of retirees who collectively implemented multiple strategies, including strategic Roth conversions, qualified charitable distributions portfolio rebalancing, and full utilization of the enhanced senior deduction. In a single tax year, this group achieved total tax savings on their Social Security benefits exceeding $120,000, with individual outcomes varying based on specific situations, yet sharing the common success factor of fully absorbing complete educational content before execution with expert guidance. In full summary, this 2026 SSA Tax Alert has delivered exhaustive coverage of Social Security benefits, taxation mechanics, the decisive importance of the combined income formula, the substantial advantages offered by the enhanced senior deduction, the benefits of delaying claims, Roth conversion strategies, investment portfolio management, charitable planning tools, state tax considerations, tax loss harvesting, and multiple detailed beneficiary examples, demonstrating exactly how these approaches enable successful keeping of Social Security benefits untaxed. Don't forget to like this video, subscribe to Macro Signal right now, and activate the notification bell so you receive every future critical update on safeguarding your retirement income. Share this complete presentation with your friends, family members, and anyone else you know who relies on Social Security benefits, because the knowledge contained here possesses the power to meaningfully transform their long-term financial security as well. And above all, take decisive action today by reviewing your own current combined income projection and consulting your tax advisor before the tax filing deadline arrives, so you can keep your Social Security benefits untaxed successfully. Thank you sincerely for watching this entire video all the way through to the end. Your commitment to absorbing these detailed insights will translate into a significantly more secure and tax-efficient retirement, with your Social Security benefits kept untaxed exactly where they belong. We look forward to seeing you in the next informative Macro Signal video.